Welcome to Money Secrets with Bill and Mike.
I'm Bill Alexander.
And I'm Mike Tove. And Bill, we're going to, we're at that time of the year where taxes are starting to kind of implode on us.
Truthfully,
again.
it doesn't matter what time of year it is. Taxes are always important.
Yeah.
Actually, we have a wonderful guest this morning. It's a pleasure to welcome John Rukosky of Rukosky and Associates. We need to talk about tax planning this morning. I know that I do some at WG Alexander and Associates. We're a law firm here in Raleigh.
And I do some to the extent that I'm allowed at AIN Services. And we do financial planning, but we're not CPAs, so we have to rely on folks who are.
And other accountants and enrolled agents. So we need to learn all about that.
So we're going to come back in a minute and we're going to see what we can find out. And we're back. So, Bill, why don't you introduce us to John?
Well, John is someone that I have worked with with a number of years. John, first of all, I know that you're an enrolled agent and that Rukosky and Associates does a lot of tax planning for folks in this community. So can you tell us what an enrolled agent is and a little bit about Rukosky and Associates?
Enrolled agents are not well known. I don't know that they do a lot of good advertising on that. People typically think of a CPA as someone to do their tax work. And in most cases, CPAs do certified public accounting. Enrolled agents specify taxation. So we're a specialist on tax.
Okay. So if I wanted to just get my taxes done, is this something I would come to you for potentially, or?
Absolutely. We prepare over 850 tax returns each year in the Tri-County area.
Well, I'll tell you what, John, for me, getting my taxes done, it's always a pain. We all have to do it. But truthfully, tax preparers as a whole, they just tell you what you have to pay. In other words, they formulate it all up, and then it's sort of like, pay this bill, and it's like, oh, okay, if I have to. But what's important to me is not the tax preparation, it's tax planning. It's what can I do to reduce the tax that I pay?
What you said is the most common complaint we get from people that come to us, is that they simply take in their information, it gets put into a return, and they get billed. And then they haven't got any idea of how to correct it.
Well, that's true even for those folks who go to CPAs or other accountants or any tax preparation firm. And what people really need is tax advice. What can I do so that my bill next year is lower than it is this year?
Sure. I mean, the proper way to do someone's tax return is to start with the year before. Find out where they've been, where they're currently at when they walk in the door, and try to get them to a better place in the next coming year.
Would it be fair to say that the big mistake, the money secret to avoid, is that if you get to the end of the year and you go to the CPA, whatever you've got is ancient history, basically. It's done. And you don't get to fix what you did or didn't do or you should have done.
Which is a major complaint that we have against other preparers that don't finish returns until May, June, July, because the year is half over. There's no planning to be done. We've heard of different firms giving out or preparing the returns as far as August. Well, how is a small business person supposed to plan around that?
Right.
It's ridiculous, actually.
Well, let's go back. So are there some things that folks can do, either individuals or small businesses? You know, here it is, November, December, and now it's January, end of January. Is there something that I can do now that might reduce my taxes?
Well, certainly that would fall into the IRA area.
So I can still make contributions to an IRA for 2016.
All the way up till April 15th.
Right.
So if I have the extra money that I can actually push over, then that's something that I can do to reduce my taxes.
Absolutely. You want to sit down with someone who is not just doing your taxes, but someone who's willing to plan it out with you. It doesn't take a long time. All you have to do is take a look at last year's return. You can tell a lot by an individual where they're investing, where they're giving for contributions, what their medical situation is, and hone in on those things and start to plan them for the next year with a lifesaver of an IRA if we have the opportunity.
One of the things that I run into is with clients is that they only want to look at things 1 year at a time. And so everything is always on a short-term picture. But to me, tax planning is also not just looking at this year, but looking 5 years out, 10 years out. Now, I know we can't figure out what the tax laws are going to always be, but from a generalized standpoint, I always like to think if you don't look at the long-term picture, you might be missing opportunities.
Oh, I agree with you. And really, you're, in the tax business, you're probably looking at 3 to 5 because the landscape changes so often. But take an individual who is 30, they're probably going to look 3 to 5 years out. Take a look at an individual who is 40 to 50, they have a different goal in mind. So you can look 10 years out, and you should be.
Well, as an attorney who does tax planning myself, you know, it is a landscape that we have to look at, knowing that tax laws can change next year and then they'll change again. We know that. But, you know, we've had a big election that has changed dynamically what's going on in the United States.
Absolutely.
And I'm very focused on income tax right now. So, John, as it relates to knowing the fact that we have a Republican president who's very opinionated about taxes, and we also have a Republican Congress, do you expect some significant tax changes to take place, as I do? And if so, what are you advising your clients?
First of all, there are definitely going to be changes. We know that it's probably a very strong thrust to go into 3 different tax brackets. Now, that squishes the amount of place that I can go in the tax system without a large ramification. So where there was 5 before, I had a small ramification. Now I'm going to have a large one because there's only 3 brackets. So it's even more critical to find out from last year's return, this year's return, to take a look if somebody is going to hit those thresholds and really kind of transform their family.
Yeah, one of the things that I've seen, and I can remember a number of years back with some of the previous major tax changes, is that we, on the one hand, it's almost like a magic show where over here they're saying, we're going to reduce taxes over here, and then on the other side, on this one, they're saying, yeah, but we're going to eliminate deductions and we're going to do things. We have seen tax structured rates come down and revenues actually go up in some cases because they got rid of all the deductions. Do we see anything on the horizon?
From what I understand from the administration is that they are going to gravitate towards somewhat of what we would call a flat tax.
Well, when we come back, let's talk about that.
Yeah.
Sure.
And we're back with John Rukosky and
Well, John, you just mentioned the possibility of a flat tax, and obviously that may be a possibility for 2018 or 19. So what do you tell folks today in terms of preparing for what could be a very different landscape with income tax?
Every year laws change, but every once in a while you get a huge impact law. And these laws are going to be a heavy impact. This is not the year to be just doing your taxes. This is the year to be doing tax planning, to sit down with an advisor, show them where you've been, where you're at today, tell them where you want to go, such as investing in certain things. Would that be the best move? And have that tax advisor try to anticipate the laws that we have heard are coming down, such as jumping from one lower bracket to a much higher bracket and finding maybe investments that would take back some of that income tax possibility. That would be one very, very big thrust.
is it going to be a case where the folks in the middle to lower tax brackets are actually going to need much more of the planning than the folks from the middle and above?
The way that it's structured right now, from what we understand, they're going to raise the standard deduction, which is going to take away a lot of the deductions that people are in that bracket that you're talking about are taking today. Frankly, the tax returns, the tax laws are a form of social engineering. We want you to go to college, so we're going to allow you to write off education fees. We want you to stay off of some kind of public assistance, so we'll give you an earned income credit. This has been going on for 20 years now.
20 years, more like 100 years.
Right.
It got more complicated after 1903, yes, I agree with you.
Well, here's the thing. With flat tax, obviously, there are lots of folks who are in the 15% tax bracket, 25% bracket, 30%. 39.6% is the highest federal tax. And then you have capital gains tax for most folks is 20%. Flat tax, I think they're talking about a 10% flat tax. So, I mean, I'm just surmising here that if my deductions are going to go away next year or the year after, that it might be wise to take as many deductions as I can take this year?
Sure, it's always wise to take as many deductions as we can always get legally.
Well, but sometimes you can push deductions into one year that you otherwise could push off to another year.
Sure, absolutely. And as we get clearer on the laws, we'll be able to understand where to push them into. But just focusing on income to begin with, are people taking income that they don't really need to live on, and putting that aside? For the typical individual in the 99%, that person is going to see more and more deductions taken away. So the place to go for them would be to at their employer benefits, take a look at their 401k contributions, take a look at their health savings account plans, child care plan credits that they can utilize from their employer to lessen their income, and it was money that they may have already been spending anyway, such as on child care.
Well, you mentioned the word HSA, which I know is a health savings account.
Right.
I want to make sure other folks know that too.
Yes,
and
it's
of course, I know that that's limited to only folks that have a qualified high deductible health plan.
Correct.
And so not everybody's got that, although a lot more folks are going to those high deductible
They are.
plans.
We're seeing that on their W-2s, Bill.
Right.
Yeah.
And of course, if you're already retired, that's not a possibility because you can't contribute after age 65.
Right. So the answer to your question is a little complex. Who are we talking about? The person who's maybe in their 30s and 40s, they're going to be looking at their benefits at work first to shelter income. The individuals that are older are looking to generate income but have it be tax deferred or tax free. So.
Right. And of course, with IRAs, even if your employer is only contributing, say, 2 or 3 or 4% as a match, I mean, it's always a no-brainer to at least do what your employer's matching. But
Sure.
From what I see, people are really not saving enough for retirement. And you can always ask your employer to deduct more for your IRA, 5%, 10%. And actually what I'm telling my own children is to take a 10% for their IRA. Even though they're in a very, very low tax bracket, I'm afraid they're not going to have enough money to retire on when it gets...
The one challenge I have with that is that when the money is in a 401k, you are giving up an enormous amount of control to the HR department who is handling that. You limit yourself on investment choices. You may be restricted in terms of being able to access the money. And so I tend to emphasize the idea that if you always want to put in enough to get the maximum promised match, but beyond that, use vehicles such as traditional IRA or SEP that are on your own so that you can control it, you can get to pick where the money is, you can change it, you can actually take it out if you need to, transfer it. You have the controls. I don't like giving up control needlessly.
I completely agree with you. You've got to have the flexibility. Take advantage of the employer giving you free money. If you're putting in 6% and they're matching 6%,
absolutely,
you just got 100% return on your investment. Where are you going to get that? But after that, the employer is responsible for what they offer And that was a major consideration when these plans first started back in the late 80s and early 90s. So they've weaned it down now to what I call cookie cutter plans.
Right.
Retire at 2020 and 30 and 40, and they're walking you through these stages of life.
Well, the
Yeah.
biggest problem I see with 401ks is that employees pick a few investments,
Right.
and then they don't go back and revise those. I mean, nobody should be doing that. Everyone should, in fact, keep up with where their investments are. And sometimes that's hard to do with a 401.
So let's come back to that after the break. And we're back.
Well, Mike, I think what you just said is a money secret.
Yeah.
And that is use your employer match 401k to the maximum match, but that's not going to be enough for an awful lot of folks. And so the rest they should be putting into an IRA, which they can control, which is
Or even anything that's tax deferred. So for example, and we've done this, but if you use an annuity, for example, a non-qualified annuity, that's tax deferred. It works like an IRA to the extent that you get the benefit of tax deferral on the money, but then you don't have a requirement to start liquidating it at 70 and a half. And when the money comes out, it's not 100% of it taxable.
Well, that's true, but the benefit with an IRA is that you get a deduction from your income. You're not being taxed on it when it goes in, which is nice.
Yeah, Bill, that's like pay me now, pay me later situation.
Right, exactly.
But it does come into the planning of it. You were mentioning tax brackets before.
Mhm.
I focus more on the effective tax rate.
Mhm.
Someone may be in a 10% bracket, but by the time their deductions are taken, they're at 0%.
Right.
And back in 2004 through 2008, we were seeing people not paying taxes at all.
Right.
And it was benefiting the working class, the middle class, if you will, much more heavily than it was the upper. But you hit upon the problem, and that's the education or lack thereof.
Right.
Personally, I think it's just somewhat of a crime that in our country we are allowed to graduate from high school without even knowing how to fill out a checkbook. We're allowed to graduate from college without knowing anything about loans and credit. It's all education, and we're too busy working rather than taking time.
No question about it. But even highly educated folks, we all know folks who are great in their field, but they have no clue about finance.
Well, I get that a lot.
It's true.
And I get that on the flip side. I'll get people that will say to me, well, my son is a doctor, and so he knows, he's really smart. And then they'll use that to contradict what I am giving them as a financial planner. And it's like, well, wait a minute, would it be fair for me to contradict what a physician's advice was because I'm real smart in my field?
Well,
Mike, I would simply say that why are you here?
right. Well, taxes are really very important as it relates to any kind of financial plan. And
Sure.
John, that's one of the reasons why you're so busy and why it's really important for folks to talk to folks like you who can merge financial planning along with tax planning. It's just so important to folks.
We're an odd animal, we do both.
Well, one of my biggest concerns is to the degree that the country may move towards a flat tax. I know that Congress is a revenue neutral type of thing. In other words, if they reduce taxes on one end, they're going to increase taxes on
Sure.
other folks.
Mhm.
And one way they're going to do that is to eliminate deductions. Well, which one? There are an awful lot of folks who purchase and invest in real estate that depend on real estate deductions, if you will.
Sure.
And so it'll be interesting to see how that goes away. And it also may push people towards creating their own businesses where they have business deductions in terms of expenses as opposed to personal deductions.
Out of the 750 clients that we've got, over 300 have side businesses because there aren't enough jobs to go around in the economy, and because the wage is stagnating, we are finding that the typical family needs 2.5 jobs to be able to afford the extras that we used to get years ago.
Well,
right?
Truthfully, from my perspective, and it may be even more important with new tax laws on the horizon, is that having a side business can actually be one of the real money secrets in terms of being able to deduct more and pay less.
We have seen about a 13% increase in side businesses since the Great Recession hit. And the ones that were affected the most in that recession were age 45 and up. And so now trying to go back into the market, maybe finding they can't get back or their training has to increase, they've started side businesses. So we're having a lot of advice on those.
Well, even retirees like to have.
And we're back. So Bill, that was a very fun topic. And we're going to
It's
have to
an
do some
important
more
one
of it.
too. Absolutely. We'll need to get John back.
Yeah, absolutely. So anyway, so I'm Mike Tove of AIN Services. We do financial planning, insurance, investment planning. We're located in Cary, North Carolina, and you can reach us at 800-363-2296. Check us out on our website at www.ain-services.com.
And I'm Bill Alexander. I'm the founding attorney of W.G. Alexander and Associate. We're a law firm that focuses on estate planning, elder law, and asset protection. I would also encourage you to listen to my radio show on asset protection because that is such an important topic to us. And it's called Asset Protection Today. It airs at 11 a.m. on Saturday mornings on WPTF.
And so, thank you for watching, and we'll be back next week with another wonderful topic on Money Secrets with Bill and Mike.
See you then.